All right, so the first thing I want to look at is the Palantir stock price. So let's jump right in. As you can tell, it's been as high as, 39. It's actually been as high as $45 for that one day. And then it had a lot of sideways and down action that ultimately led to it being priced in the 20s and even had its lows down here in the $18 price range. And personally, I think we could see that once again. But in my opinion, that might just be a good opportunity to buy. And this hasn't updated all the way, but as you can see on the screen, that the current price is sitting around $21, $22, and the fair value for the stock is around $20. So that's not terrible, but some other people think otherwise. They think that this stock is heavily overvalued with no potential upside, and we'll get into all of that in just a minute and hopefully do a little bit of debunking as well. So this stock is seen as slightly overvalued, but when you take a look at its growth, just from Q3 of 2019 to Q3 of 2020, you saw a 52% growth in their total revenue. That is super good to see. And if they can continue that growth, which I think not only can they continue, I think they can actually increase it before they turn into an absolute behemoth when it comes to data analytics and similar software products. Now let's look into this article on Seeking Alpha. Now, no hate to the author, but we're gonna use this article. So if you go here, it says 3 reasons to avoid Palantir, and we're gonna go through each single reason pretty swiftly. So long sales cycle and the lack of scalability. Yes, they do have a longer sales cycle. In fact, a lot of their projects and contracts are very long tailed. And a lot of times they actually expand. So maybe not something to really complain about because they make even more money year after year after year, especially when it comes to renew those contracts. And most companies and, the military, they always come back with more money because it works, right? Their product works and they're willing to spend the money. And so next, when we talk about lack of scalability options, I think that's false as well. A lot of people are saying, well, they're just a SaaS company, that's all they do, and they're terrible at it, and they're a one-trick pony, and that's all they do. But in fact, they have so much more. And they're always optimizing their current products and, of course, bringing in new ones. They just added a product recently. If you go to their website, you can find Palantir Unlocked. I'm assuming that it's not perfected, but look, they're launching more products, and that's good to see. So they're not a one-trick pony, and in fact, they have 3 products under their belt, and this is the 4th one. And ultimately, I don't think it's going to stop there. But again, time will tell, right? If they were a one-trick pony and they had all these issues, why would ARK Invest be still buying up shares? These big firms that are invested in Palantir, we want to see them holding on to their shares, because if they sell their entire position, then we could start to worry, well, maybe this unicorn is at the top of its sales cycle. It's going to be the end for it. There's not much room for its growth. That's why everyone's getting out. But in fact, yeah, they had this little tiny sell position, but in fact, they still hold 27 million shares. And if the stock price goes down any further, I could see them buy a decent chunk once again, just like they did when it hit $18 and $20 here. Obviously, this is just one firm that's buying or selling their stock, but it's a very good indicator because ARK invests into innovative and disruptive technology. And they believe that Palantir is just one of those insane growers, meaning they're going to grow into the long distant future, and their current market cap, 30 to 40 billion, is nowhere near their full potential. Now, as far as their growth is concerned, this is a recent article where Palantir reported 49% revenue growth for Q1 of 2021 versus Q1 of 2020. Very interesting to see, and it paints a good picture as far as their growth trajectory. Last we checked for Q3, as you remember, 52% growth. So pretty neck and neck with current data, right? And as long as they continue to grow those numbers, we're gonna see a very, very profitable Palantir in no time. As far as average revenue per customer, that has also grown 38%. And average revenue of top 20 customers has grown 36%. Now, this data is a little bit dated, but it's still third quarter of 2019 to third quarter of 2020. They're growing not on just on the overall revenue, but each individual customer is paying them more money to increase the amount of services that are being handed to them. And so when we talk about those long sales cycles, that's good. You want your customers that have the long sales cycles with you to increase their revenue as time goes on. That's what we see here. And again, when you take a look at their revenue, this is the full year on the right, you see from 2019 to 2020, they grew at 47% in revenue. So not just quarter by quarter that we compared earlier, but they've actually grown an insane amount of revenue. In fact, $1.093 billion in revenue, up 47%. Good to see. And when it comes to the number of customers generating a certain amount, those numbers have also increased. From 2019 to 2020, customers that were spending $10 million or more, they have increased 50% in revenue. In fact, the same thing can be said about customers that were bringing $5 million or more. They were bringing about 54% more in revenue. And the $1 million or more customers, right in between the $1 million and $5 million range, they've also increased 32% in revenue year over year. And this is obviously looking back 2019 to 2020, since we don't have 2021 numbers yet. And in Q4 of 2020 alone, there were 21 deals signed, each worth $5 million or more, 12 of which were worth more than $10 million or more. So if you're not familiar with Palantir, most of their contracts come from either the government or giant corporations. Now people are like, well, that limits their upside. They can't market to smaller companies. Well, when you look at their product and you see that it works extremely well, when you're a medium to large size business, you're gonna notice that the giant corporations are profiting in insane amounts and increasing their spend with Palantir. They're gonna say, well, we wanna do that. We wanna have that same profitability and of course, increased growth. Maybe we could just do $1 million contract, and we'll probably start seeing that as well. And when they get the same results that the giant corporations are getting, they're gonna say, well, let's double down, let's triple down, let's spend 5 million, let's spend 10 million. And Palantir's business model, through no marketing at all, really just word of mouth and results, turns medium-sized companies into large corporations, and might even consider adding a smaller, more inexpensive product for the small consumer that can kind of try out their product. And then once their business grows, they sign up for the bigger contracts as well. So I think that there's unlimited potential for Palantir. And when you think about it that way, meaning the long term versus the very short term, they don't have the possibility, they're only serving these type of clients, then of course you can get lost in the transcription and be like, well, I don't know, maybe Palantir's not worth me investing my money in. But when you think long term, the whole thing changes. Now let's get back to the article because it has something very important. So they say that the reason number 2 why you should avoid Palantir is the shareholder unfriendliness. And more specifically, Palantir has an excessive stock-based compensation program which is hurting the company's bottom line. That's what they say. When in fact, when you take a look at companies that have stock compensation plans versus, certain type of salaries, those companies typically perform better. Not only that, but their stock performs better. Tesla is a great example of that. But let's look at the advantages. So the advantages of stock-based compensation is that it creates an incentive for employees, and most of these are, higher ups, but let's say all employees, to stay with the company. They have to wait for shares to vest. It also aligns the interest of employees and shareholders. Both want to see their company prosper and the share price rise, so that way they can benefit. And the other addition, this is more on the company side, is it doesn't require cash. And that leads me into the disadvantages. Well, it obviously dilutes ownership and kind of hurts the stock price when the shares are being handed out, right? And in addition, it may not be useful for recruiting or retaining employees if the share price is decreasing. And again, that doesn't really matter all that much if your employees aren't short mindset individuals, right? If they're invested for the long term. So when talking about the disadvantages or advantages of stock compensation plans, I think there are a lot more advantages for it than disadvantages. And in most case scenarios, it benefits the employees and the company overall as well. But the next reason is our final reason, and that is valuation. They say at a market cap of 47 billion, Palantir is priced like a high margin SaaS company, even though it doesn't operate like one. In Q1, Palantir generated only $341 million in revenues, and in Q2, it's expected to generate $360 million, and for the year, only $1.48 billion in revenues. Considering those numbers, it will take years for Palantir to reach its current valuation, even if it continues to grow at its current rate. And there's no guarantee that its growth won't slow down in the upcoming years due to the limited pool of potential customers. We already covered the potential customers. I think that pool will only increase. And again, they mentioned that it's operating as a high margin SaaS company, even though it has way more products to offer than just a SaaS product. But let's dive into the numbers a little bit further, okay? So first, let's look at their balance sheet. As you can see, they don't have a lot of debt. They have some other, liabilities, about $1 billion, but they have a lot of short-term investments and cash. They have long-term assets and physical assets, receivables, but not a lot of debt. That's good to see. A lot of their spending comes to developing new products. They're not spending anything on marketing. And that is one of the few companies that doesn't have to market in order to get new customers. Literally, the product speaks for itself. And just like Tesla, that's what they've done for years, and look at them now. Let's take a look at this financial update. So by the end of 2020, Palantir grew revenue and generated positive contribution margin across all three phases of their business model. And when you look at their total revenue increase, it's absolutely insane. And for someone to write an article saying, well, they just aren't growing that much, they're limited. No, in fact, they've just barely started growing. And I know what you might be thinking, this company's been around forever when it comes to, the private sector. Why hasn't it grown like its competitors? Well, let's take a look at the total customer base versus peers. This is a lot of people's way to show the pessimism behind the stock, when in fact, I think it could show the optimism, right? So Palantir has little to no customers. So you can see here compared to Viva, Snowflake, Zscaler, JFrog, ServiceNow, CrowdStrike, Okta. I mean, we're talking about companies that have thousands of customers when Palantir doesn't even compare. But yet Palantir makes a lot of money and they're able to grow their revenue year after year after year. So what does that tell me? Well, that tells me if they were just to take a little bit more market share from all of these other companies that have so many clients, as long as those clients are willing to pay for Palantir's product, which they will, as long as they see results, which organizations have been, that will lead them to not just having more customers, but also owning way more market share than they're getting credit for today. And so with all of that pessimism aside, let's look at some more positives, because I like to look at both spectrums. So here's some well-written bullish theses for Palantir. Palantir's revenue from government customers rose 73% year over year to 420 million, 420, or 55% of its top line in the first 9 months of 2020. Also, during the third quarter, it secured a new AI contract with the US Army. In addition to all that, we have the growth potential in the enterprise market. So if you're not familiar, Palantir helps enterprise customers process data with its Foundry platform. That's one of its products. The Wall Street Bears often claim Foundry faces too much competition in the enterprise analytics market. But Palantir's enterprise revenue still rose 30% year over year to 320 million, or 45% of its top line in the first 9 months of 2020. And if you dig a little deeper, during the third quarter, Foundry signed a new contract with the National Institutes of Health, renewed a contract with a big aerospace customer, and pulled a major consumer goods company away from an unnamed rival. And at the end of the day, it's a great artificial intelligence play. With all those things said and done, I hope you can see the potential growth in Palantir, or maybe if I missed something, feel free to share that down in the comment section below.